Should you be looking at syndications that are doing interest-only loans? What's going to happen right now? We don't really know, but it's really interesting. There's a huge search going on. A lot of brokerages are seeing people come to them and ask for an interest-only loan. With interest rates going up, people are looking for safety. We've seen a lot of syndicators take out bridge loans for their syndication properties. Is this going to end up in foreclosures? We're going to answer all of these questions today here on Purpose Driven Passive Profit.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
If you're new to the show, his name is Nate Armstrong. He's the founder and CEO, Inc. 500 company, Home Invest. We've done more than 1,400 deals, more than 400 syndications, more than 40 large syndications. My name's Steve Warner. I'm your Chief Investment Officer. All right, Nate, we are going to jump into this. What is going on with interest-only loans, and how does this affect investors?
Yeah, well, this happened last time that interest rates started to go sky high as well. We're not sky high yet, but we're higher than we have been, especially during the pandemic years. And so people are trying to find cheaper loans. They're trying to get their monthly payment down. They're hoping that they can buy that dream house, but unfortunately, because interest rates are high, they get pinched. They can no longer afford the monthly payments. So a lot of lenders come out with these loan programs where they're more attractive because they're interest only. You're not paying down the principal. So it softens or lessens the monthly payment. And so that's kind of the lure to get into them. But they're scary right now, man. Let's see.
If you were to take one out, it's basically betting that sometime in the next couple of years, interest rates are going to come down and you're going to be able to refinance out. Well, we saw people do this with syndication loans, which is, it's the term for that is a bridge loan, right? When they start the syndication, they take out something that's interest only to get the property going, but now they're not able to get out of the property, right? They're not able to refinance into a long-term fixed rate. What's happening to syndicators that did this?
Yeah, we saw the first one about 3 months ago get foreclosed on. They just handed the keys back to the bank because they couldn't come up with a refinance strategy for it. Now, I should point out, Steve, that there's a difference on interest only that are fixed and interest only that are variable. What variable means, for anyone that doesn't know, is that it varies. The rate can change. You might enter the loan today at 6%, but then 2 years from today, it goes to whatever the market rate is. And that might be, they might call it prime plus something. And if that's the case, that means that if interest rates keep going up and up and up and up, your 6% loan might very well turn into a 9% loan or an 11% loan. Or, I know this one might sound a little bit crazy, a 20% loan. And that's actually happened. My parents, when they started buying a lot of properties, that's the interest rates that they faced in the early 80s and the late 70s. And so it's not too far in our distant past that these things actually were the case. And then the other one, so that's variable. Fixed, interest only that's fixed, that might be a play for someone that's definitely planning to sell the property at some point in the next 5 to 10 years. But an interest only that's fixed, that's a little bit of a safer landing pad. That's basically locking into a 6% rate today and having it hang out at 6% and then planning to sell the property at some point in the future.
I mean, the risk that they're running, right, is if it comes time, they've got 6 months to sell and interest rates are sky high like they are right now, or something is going on in the market where they're not able to sell, what happens?
To the person that took out the fixed interest only?
Yeah.
If they only took out like a 6-month loan or even a year or 2 years, then they could get in trouble. We're being quoted, like we've got a $12.4 million deal under contract right now. We're taking it through due diligence. And the lenders have been offering us everything under the sun for loans, for loan terms and rates and all that kind of stuff. And one of them that they offered was a fixed for 10 years interest only, right around 6% interest. And the loan terms, they're not horrendous. It's not horrendous. I much prefer to take out something that pays down the principal over time with each payment. But in some cases, it could make sense for that. Where the scary ones lie is if you take it out for a year or 2 years, and then it can turn to a variable at the end of that. I would not want to get caught in this interest rate cycle, expecting that rates will go down at some point and then find out that they don't, and then be caught basically in a tough spot. I wouldn't want to be in that spot.
Well, let's go ahead and go there and talk about that, because we're starting to see some of these where these people had these loans. Now they're into a variable interest rate. They're getting hammered on payments. What are we going to see in the multifamily space? These people that had bridge loans, we're going to see them hand the keys back. Are we going to see them take on private debt? What are they going to do in order to make this work?
Yeah, I think that the majority of them, if they really want to save the deal and save their equity, they're gonna find a lender that will refinance for them, but it's going to be called a cash in refinance. Everyone's so used to the cash out refinance where you buy it, let's just say for $1 million for easy numbers. You buy it for $1 million and then you do some improvements to it, you boost the rents, then you send a new lender in and you do a refinance and they appraise it for 1.5 million. Now, all of a sudden, you get to pay off the $1 million that was originally put into it, and you get to take cash out of the property and put cash in your pocket. That's the cash out refinance. I think the days of cash out refinances are numbered. It's not that they're going to go away forever, but they're going to get more difficult during this season of interest rates and this season of real estate investing. So this next season, we're going to see more of the cash in refinance. That's where you bought it for $1 million. You think it's going to appraise for 1.5, but it only appraises now for $1 million. It's the same value you bought it for. And the new lender says, hey, interest rates are higher. That means you're going to have to put in more money to make this thing cash flow. And then you're going to find people, syndicators like that are going to have to actually do a capital call to bring more money to the table to cover that gap. So I think we'll see more cash in refinances.
I think we'll see that as well. We're also going to see some people handing the keys back to the bank, which is going to be good for us because we will be able to find more great deals. I'm trying to think, like, if you were an investor looking at a deal, you would just want to make sure to ask what kind of loan they're taking out, right? That's the main question that you want to make sure of right now.
Yeah, every deal that we're a part of right now, and every deal that like gets brought to us that we're looking at as potentially taking on, we are always looking at the debt structure. We kind of have an internal saying that debt drives decisions right now. We don't want to put our investors or our reputation on the line. It's just not worth taking any risks right now. And so every single time we look at what is the debt that's available. Even this $12.4 million deal, the first question that I asked was, what is the existing debt? Can we take over that existing debt? And in this particular case, we couldn't because their debt's actually expiring in the next handful of months. So we couldn't take over their existing. Now, Steve, as you know, because you and I are partners on these, the last three out of 4 deals that we've closed, we actually structured seller financing or to assume the existing loan on the property. And that's a really powerful play. Most syndicators do not understand how to get that done. They might know about it in theory or concept, but actually getting it across the line and leaving the existing mortgage in place, it's very difficult for a lot of investors.
Yeah. I mean, that is what sets us apart. We find off-market deals and we find ways to do creative financing with the seller, which locks in lower interest rates, usually like a long-term fixed debt, which is so much better than anything you would get with banks. If you want to read about our current offer, you can click on the link down below. It is in the show notes, or if you're watching this on YouTube, it's in the description. You can book a call with myself or Sue, our head advisor. We'd be happy to talk to you about the current deals that we are working on and work you through the debt structures that we have to show you that they are safe, long-term fixed debt plays. Anything else that we missed, Nate?
No, just make sure right now you're being a good steward of your investments. Follow Matthew 25. Remember in the Bible, it talks about being a good steward of your money. Don't bury it under a rock. It's not the time for that. Instead, find investments that can hopefully help you 2x your money over a reasonable period of time.
All right. We'll see you next time here on Purpose Driven Passive Profits.
Thanks so much for listening to our show today. Here's Nate with our latest offering.
Hey, accredited investors. I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
We'll see you soon here on Purpose Driven Passive Profit.